Every time natural gas prices spike, grocery bills around the world climb 12 to 15 months later, and that connection between the gas wellhead and the price of bread traces back to a single chemical reaction that feeds 8 billion people. Most viewers watching this already sense that food keeps getting more expensive. But what almost nobody realizes is that the molecule responsible for growing nearly half of all crops on Earth comes directly from fossil fuels, which means the cost of rice, corn, wheat, and cooking oil will never drop below wherever gas and coal prices decide to settle. That link between your energy bill and your grocery bill tightened permanently in 2005, and what happened in January 2026 proves the worst consequences are still arriving. The modern food system stopped running on sunlight and rain decades ago. Agriculture today functions as an industrial conversion process, turning fossil fuels into calories through a chain of events that takes roughly a year to complete from wellhead to checkout counter. And the mechanics of that chain explain everything about why food prices move the way they do. The chemistry that feeds the world. More than a century ago, two German chemists invented the Haber-Bosch process, a reaction that synthesizes ammonia from atmospheric nitrogen, and that single piece of chemistry now feeds roughly half the human population, because ammonia serves as the building block for all nitrogen-based fertilizers, including urea. Without nitrogen, high-yield crops like corn, wheat, and rice simply cannot deliver the volumes that modern civilization depends on. What makes this vulnerability absolute is the raw chemistry itself. Natural gas does not merely power the factories producing fertilizer. Natural gas supplies the actual hydrogen atoms fused with nitrogen to create ammonia, and producing a single metric ton requires roughly 34.4 million British thermal units of that gas. That feedstock dependency explains why natural gas accounts for between 70 and 85% of ammonia's variable production cost. And the moment gas prices jump, nitrogen fertilizer reprices immediately, with no lag and no substitute available. China operates a parallel version of this dependency. Chinese fertilizer plants rely on coal gasification rather than methane. And because China commands roughly 1/3 of global urea capacity, with about 75% of its nitrogen output running on coal, domestic Chinese coal prices effectively anchor the floor for global urea exports. Safety inspections that slow mining, power demand surges that redirect coal to electricity generation, government rationing during temperature extremes. Any of these push coal higher, and the entire global nitrogen market responds. Phosphorus tells a different story with the same ending. Phosphate fertilizers like DAP, diammonium phosphate, require sulfuric acid to extract phosphorus from mined rock, and the sulfur needed to produce that acid comes predominantly from crude oil and natural gas refining. Oil climbs, sulfur follows. And in recent market cycles, sulfur prices nearly tripled, dragging phosphate costs up with them. The first link in this chain leaves no room for alternatives. Natural gas, coal, and crude oil are not optional inputs in modern agriculture. They are the literal molecules that crop yields are built from, and no technology currently exists that can work around them at scale. When food becomes fuel, a second channel connecting energy markets to food prices appeared around 2005, and unlike fertilizer chemistry, this one operates instantly. Rising crude oil prices improve the economics of blending ethanol and biodiesel into commercial fuel. Ethanol draws primarily from corn in the United States and sugarcane in Brazil, while biodiesel sources from soybeans across the Americas and palm oil throughout Southeast Asia. Government mandates lock these connections in place. The United States Renewable Fuel Standard and Indonesia's B40 biodiesel mandate, which requires 40% palm oil blending in diesel, establish a hard price floor under these crops by turning them into energy commodities alongside food commodities. That dual identity creates a direct pipeline between crude oil markets and grocery shelves. When oil surges, millions of tons of corn, soybeans, and palm oil get physically pulled from food supply chains and poured into fuel tanks. Between 2004 and 2008, the volume of grain diverted to ethanol production more than tripled, and this channel keeps growing stronger. Indonesia's B40 program alone, with road testing of a B50 blend expected in late 2026, can absorb an additional 4 million metric tons of palm oil annually, which represents around 5% of total global production. What makes this channel so dangerous is its speed. Biofuel arbitrage bypasses the entire agricultural planting cycle and exerts upward pressure on spot commodity prices the moment crude oil moves, making it the single fastest transmission mechanism from energy markets to food prices on the planet. 4 crises that rewired the system. Before 2005, energy and food markets barely spoke to each other. Between 1970 and 2004, the econometric correlation between crude oil and cereal prices actually sat in negative territory at negative 0.9%, and agricultural markets moved on their own rhythm of weather, harvests, and local demand. That independence shattered between 2007 and 2008. Crude oil blew past $140 per barrel, biofuel mandates kicked into high gear, and the correlation between oil and corn prices rocketed from near zero to 23.1%. Since that structural shift, food and oil prices have shared the same macroeconomic boom or bust phase, approximately 75% of the time. Average world prices for rice surged 217% during the crisis, wheat climbed 136%, and corn rose 125%. Global grain stocks had fallen to a dangerously thin 12 to 14% stocks-to-use ratio, which meant there was no physical buffer left to absorb supply shocks. And panicked governments made it worse by imposing export bans that trapped supply locally while starving international buyers. Billions of dollars of speculative capital pouring into agricultural futures amplified the price swings far beyond anything physical supply and demand could justify. A second spike rolled through in 2010 and 2011 when severe droughts across Russia, Ukraine, and Kazakhstan destroyed the Black Sea wheat harvest, and Moscow banned grain exports. Export restrictions during that episode accounted for roughly 40% of the global wheat price increase and 25% of the maize price increase, which tipped an estimated 8.3 million people into extreme poverty. COVID-19 introduced an entirely new kind of disruption between 2020 and 2021. Crops kept growing, but the global shipping system collapsed under port congestion, misplaced containers, and labor shortages. As the economy snapped back open, a massive synchronized demand recovery collided with supply chains that were still paralyzed, and the global food commodity index surged 54%. International food prices alone added roughly 5 percentage points to domestic food inflation for the average country in 2021. And then came the event that stress-tested the entire system to its limit. Russia's invasion of Ukraine in February 2022 blockaded the Black Sea, a corridor for wheat, corn, and sunflower oil exports, precisely when Russia and Belarus collectively controlled roughly 40% of global potash trade, 16% of nitrogen exports, and 12% of phosphate exports. European natural gas prices at the Dutch TTF surged 159% between February and August of that year. Costs so extreme that European fertilizer plants stopped operating entirely rather than absorb the losses. The FAO food price index reached its all-time record. Each crisis permanently raised the price floor, and none of those floors ever fully came back down. The winter of 2026. Between December 2025 and February 2026, every one of those transmission channels fired at the same time, creating what industry analysts openly called a perfect storm. Winter Storm Fern hit the continental United States in January 2026, plunging temperatures so far below zero that natural gas production equipment across the Permian Basin and Marcellus Shale literally froze. Freeze-offs knocked an estimated 15 to 20% of daily United States natural gas output offline, at the exact moment when residential heating demand peaked. Henry Hub spot prices exploded 78%, climbing from an average of $4.26 per million BTU in December to a daily high average of $30.56 per million BTU on January 26th, and intraday trades shattered Winter Storm Uri records from 2021 by exceeding $53 per million BTU. Because natural gas accounts for up to 80% of ammonia production costs, nitrogen fertilizer repriced within days, not months. United States Gulf urea jumped from $350 to $430 per ton in January's first 3 weeks alone. Retail urea crossed $600 by mid-February, averaging between $601 and $608 per short ton, a 5 to 6% monthly jump. Anhydrous ammonia reached $862 per ton, and DAP sat at $851 per ton. What made this worse than a simple weather event was everything that landed on top of it. On January 1, 2026, the European Union activated its Carbon Border Adjustment Mechanism, essentially a carbon tax applied to every ton of imported fertilizer. CBAM raised the global floor price for nutrients entering Europe immediately, pushing Egypt FOB urea to between $480 and $490 per metric ton. Agricultural lobbies warned the mechanism could increase European fertilizer costs permanently by 10 to 30%. And because tariffs on Russian and Belarusian products were set to climb aggressively toward $430 per ton by 2028, cheap Eastern imports were effectively cut off. Beijing compounded the tightness by extending Chinese export restrictions on urea and phosphates through at least August 2026. Chinese domestic urea output had reached a record 65 million tons in late 2025. But the government locked that supply inside its borders to protect domestic food security. China holds only 5% of global phosphate reserves, yet traditionally produces over 40% of total output, and capping annual phosphate mining at 140 million tons, while banning exports removed millions of tons from the global balance sheet. Iran's Revolutionary Guard then conducted military exercises in the Strait of Hormuz, the narrow waterway that roughly 45% of all globally traded urea exports must transit, which baked a geopolitical risk premium into every ton of fertilizer moving through the Persian Gulf region. How different countries absorb the blow. These shocks land very differently depending on where you farm and what your government chooses to protect. American corn production sits at the sharp end of nitrogen costs, which run between 15 and 20% of total operating expenses. By January 2026, the urea-to-corn price ratio reached 127.74, meaning a farmer needed revenue from nearly 128 bushels of corn just to purchase a single ton of urea, a figure 15% higher than the previous year and 4% above the 5-year average. Corn prices sat stuck around $4.10 per bushel, and acreage forecasts dropped from 99 million to 94 million acres as farmers shifted towards soybeans, which fix their own nitrogen and require far less synthetic fertilizer. A projected 7% decline in the 2026 corn yield to 183 bushels per acre would push global grain stocks to their lowest levels in a decade. Here's the odd part of the American story, though. All that pain at the farm level barely reaches the consumer. Processing, packaging, marketing, and distribution eat up so much of the retail food dollar that raw commodity costs often represent less than 10% of what a supermarket charges for processed food. United States food-at-home inflation ticked up just 0.6% from December 2025 to January 2026, even with gas and fertilizer prices spiking. Europe absorbs more of the hit. After severing Russian pipeline gas in 2022, the EU pivoted to liquefied natural gas imports and brought in a record 35 billion cubic meters in the second quarter of 2025 alone, about 46% of total gas imports. European food inflation had already peaked at 17.5% in March 2023, from the direct pass-through of fertilizer and transport costs, and the average French farmer planting non-durum wheat for the 2026 harvest spent close to 14% of their total budget on fertilizers alone, roughly €29 per ton. CBAM ensures that cost floor stays elevated, regardless of where global energy prices move. Brazil carries a structural weakness that no policy can easily fix. Despite leading the world in soybean production, Brazil imports over 85% of its total fertilizer needs. Operational costs in Mato Grosso for the 2026 to 2027 soybean crop reached 4,201 reais per hectare, with fertilizers alone at 1,805 reais per hectare, the largest single expense. Margins on the second corn crop collapsed from $75 per acre down to $6, and turned negative after land rent and interest were factored in. Brazilian farmers hedged through barter ratios, trading future crop yields for physical inputs today. And during the 2022 to 2023 shock, that ratio peaked at 28.35 bags of soybeans per hectare just to cover input costs, averaging $884.52 per hectare. India's government takes a completely different approach by absorbing the entire global fertilizer shock into its own balance sheet. Urea's maximum retail price has stayed frozen at 5,360 rupees per ton since 2012, regardless of international markets, which keeps farmer demand artificially high, above 40 million tons in fiscal year 2025 to 2026. The fiscal consequence is enormous. India's fertilizer subsidy bill for that same year ballooned to 1.86 trillion rupees, approximately $18.6 billion, overshooting initial estimates by 18.5%. India successfully delays and dilutes the energy-to-food price transmission, but converts it directly into sovereign debt pressure and currency devaluation risk, with the rupee falling to approximately 91.9 per dollar by late January 2026. Southeast Asia presents a split picture. Rice growers depend heavily on urea, and a 10% increase in fertilizer costs suppresses application by 9% over time, which drags down yields for years. Indonesia responded with a dramatic 20% cut to subsidized fertilizer prices, dropping urea from 112,500 to 90,000 rupiahs per 50 kilogram sack, and NPK from 115,000 to 92,000 rupiahs, while announcing a nationwide single rice price policy at 14,900 rupiahs per kilogram for 2026. On the export side, palm oil prices held firm between 4,000 and 4,300 Malaysian ringgit per ton, anchored by Indonesia's biodiesel mandates that divert millions of tons of crude palm oil from food markets into fuel tanks. The ratchet that never reverses. One mechanism sitting underneath all these numbers matters more than anything else covered in this episode, and it explains why food never seems to get cheaper, even when oil crashes. Price transmission from energy to food is asymmetric. When energy and fertilizer prices climb, food prices follow reliably within 12 to 15 months. When energy prices collapse, food prices stay where they are. Econometric data from the Euro area demonstrates that a temporary 10% positive shock in food commodity prices lifts food inflation by 3.8 percentage points over the following year. But negative shocks, periods where energy prices drop, register a statistically non-significant effect on retail food prices. The mechanics behind this asymmetry are straightforward. Manufacturers raise prices quickly to protect margins when input costs spike. But when those costs fall, retailers absorb the difference as profit rather than passing savings along to consumers. Every period of high volatility, even when commodity prices eventually stabilize, ratchets the baseline cost of food permanently higher. What happened in early 2026 demonstrates this ratchet in real time. Chinese export bans remain locked through August. Europe's carbon border tax on fertilizers went permanent on January 1st. Military posturing continued in the Strait of Hormuz. Each of those developments raised the structural floor under fertilizer costs. And because the established 5-month lag from gas prices to urea markets means the January 2026 Henry Hub spike will fully arrive in global fertilizer pricing by June 2026, right at the peak of Northern Hemisphere growing season. Renewed food inflation through late 2026 and into 2027 looks unavoidable. Pipelines, coal mines, and shipping lanes now govern the global harvest. What happens at the wellhead today determines what sits on your grocery receipt a year from now, and the era of cheap agricultural inputs ended years ago.